Welcome to This Week in Money. I'm Phil Mackesy. Today, David Galland says we're heading for a wall. Jeff Rubin on the end of growth. And Sean Brodrick has news on gold and silver. We begin with David Galland right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
David Galland is Managing Director of Casey Research. He is also Managing Editor for the Casey Report, and he contributes to Casey's Daily Dispatch. He's online at CaseyResearch.com. David, it's good to have you back here on This Week in Money.
Nice to be here.
You were at the Casey Research Recovery Reality Check Summit a little while ago, and also at John Malden's conference. Lots of charts and tables. We're now ready to answer what you call the big question about the economy, and I guess it boils down to one of the three R's here, David. Recession, recovery, or roadkill?
Well, I hate to say it because I hate to be a doom and gloomer. I really do, but I've got to go with the latter. I think roadkill pretty well sums it up.
Okay, now tell us what you found out at these conferences. You saw all these charts. What are people saying, and what do you see us heading towards here? Tell us about the wall that you see coming up.
Well, I think the key thing, and basically, I spent the better part of 2 weeks sort of sitting in meetings one-on-one with some of the best and brightest in the country. I mean, and sitting through presentations with just dozens, hundreds of charts actually, with people like the former head of the Dallas Fed, Lacey Hunt, and Mohammed Al-Arian of PIMCO, and David McWilliams from Ireland, and David Stockman, former head of the OMB under Reagan. I mean, lots and lots of very smart people, and my whole goal was to try to really get a sense on whether or not this recovery is for real, and if it is, how what's next, and if it isn't, what's next, and sort of when might the next leg down be. And the thing that you come up, there's a couple of takeaways. One is that the reason I sort of draw the roadkill, I come down on the roadkill side, is because not a single one of these very bright people, and again, this is one-on-one meetings, and sitting through presentations by dozens of these guys. Not one of them believes that we are in a sort of typical business cycle recovery. Not one. So that's fairly eye-opening. Normally, you'd have a different point of view on that, but in this case, there isn't. The bottom line here is that all of the world's largest economies, and by that I mean the top 10 economies in the world, at this point are in real trouble. They're in real debt trouble, and it's not just the governments themselves, but the people are in big debt troubles. This is truly unprecedented, and none of the people that I listened to over that 2 week period had any solution. None of them had a single could announce or pronounce a single possible way out of this other than crash. So some were more overt about this. Some of them waved their arms around a bit more than others. But at the end of the day, there was nobody offered any solutions. Anything that was at least politically acceptable. So it's hard to come away from something like that with any other conclusion.
David, the word you're using here for all these economies, I'm not sure if this is a financial term, but it's a good one, screwed. Yes,
we are. If you go right down the list, the top 10 economies, every one of them is screwed. I mean, they are. Their debts are unpayable. Their social obligations are unmeetable. They have again populations that are struggling. They are the populations, as you would expect, are once again turning to the governments because the governments have taught them that the governments can fix everything all the time. So they turn to the governments and they say, hey, where's my chicken in the pot? And the governments have got no chicken in the pot. They've got nothing. They've just got a lot of debt. So we're going to be living through some very interesting times, and I think you're seeing it in Europe now. Where you've got places like Spain that have got youth unemployment at over 50% and just regular core unemployment at over 25%. So what happens when the hot summer comes and, these people are sitting there watching the situation just get worse and worse and worse? There's going to be consequences, political consequences, social consequences, certainly financial consequences. And so I think the big takeaway for me is that, if you know what's coming, you can take some preparations and then get on with your life. And it would be a big mistake to think that just because we've had a little bit of, a few breaks in the clouds, so to speak, that we're on the way out of this thing.
If all these bright people, David, don't have an answer and the government's answer just seems to be to throw money at the problem, are we looking at a situation in the near term where the market's going to make up our minds for us?
Well, first, I guess you got to ask the question, which market? I mean, the stock market at this point, its valuations are getting, increasingly more reasonable. But the stock market isn't the economy. The stock market is sort of acts on its own volition at this point. But you've also got the currency markets, and of course the big one, which is interest rates and the bond market. We are certainly here in the U.S. and most countries actually. Increasingly in Europe, they're starting to pay, have people demand higher interest rates. But we are in the U.S. in a huge, one of the world's largest bubbles ever, which is in bonds. You can't have the world's biggest debt ever in history and simultaneously have the lowest interest rates. The other day, the interest rates in the U.S., the 10-year Treasuries hit something like a 120-year low. So that is just not sustainable. So that's a particular market. That's a market you've got to keep an eye on, because when that starts to go up, the game is over.
You're using the word bloodbath when you're talking about the end of the current bond bubble here, David.
Yes, because, again, if you look at asset flows, people have been buying bonds like crazy, and it's been an okay trade so far. But when these things reverse, and it doesn't have to happen overnight. But when interest rates in the U.S. start going up, it's going to cause, real reverberations in the economy. This is again, as people try to get out of those positions, as the rush for the exit starts, as interest rates start to ratchet up, interest rates can move quite quickly once they turn around, and then it's just going to be the government won't be able to pay its debt. It's going to get extremely ugly, just on that point alone.
And the mainstream media, of course, will continue to talk about green shoots and recovery despite all this information.
They're having a harder time finding good green shoot stories. But yes, they, face it. We're in an election year in America, and the media very much wants Obama to get reelected. And frankly, I think he will, because the media, controls the minds of the people, if you will. So I think, they're going to keep talking about, the bits and pieces of the signs of recovery. But I can tell you that, and again, I'm not sort of a black and white kind of person. I believe that there's nuance in many things, and things don't happen as fast as you think. But I think we are truly in for a devastating crash. I think my partner Doug Casey likes to call it the Greater Depression, and I've always sort of resisted his analogy that it's going to be worse than even he thinks. But after spending a couple weeks really, even going deeper on the subject with people with different points of views, by the way, this is important. This is not just a bunch of doom and gloomers. These are establishment types. You can't come to any other conclusion that we're headed for a crash.
We are talking to David Galland from Casey Research here on This Week in Money. And it's interesting, you mentioned here, quoting Harry Dent, that the U.S. government debt is about $14 trillion, and that's nothing compared to the corporation and consumer debt, which is almost 3 times that. We are afloat in a sea of debt, but the bottom is sprung holes, and so people are trying to deleverage. Dent's point of view is that this means we're in for a deflation. He also makes a very good argument
as far as demographics being a driving force on all this stuff. Where we disagree with Dent is that, past situations such as this, where you've had this huge amount of debt, like, for example, ahead of the Great Depression in the U.S., it was followed not by inflation, it was followed by deflation. But the difference, the thing that Dent doesn't take into account is you had a different monetary system back then. Back then you had the monetary system was reasonably fixed, whereas today it's completely cut loose from reality. We're in a fiat system worldwide. So the governments can continue to step up to the plate and unleash another wave of quantitative easing. So that's our view that says eventually this resolves in inflation. Now, in the meantime, you're certainly going to see some deflationary pressures. I would be very cautious about things like industrial metals. I like energy, but I think the oil could come under pressure for a while here. Gold is, to me, really remains something you need to own, and I think the gold stocks are getting very cheap and worth looking at this point, especially the big ones.
David, for folks who are listening to the podcast who have not experienced deflation, who maybe never heard of what it does, paint us a picture of what a deflationary environment would look like.
The good news about deflationary environment is that your dollars will go further. So it's actually not all that bad a thing. But you will definitely have a contraction in credit, the availability of credit. You will have the situation becomes, businesses freeze up, generally speaking. So enterprises will freeze up. People conserve their cash because cash, of course, becomes worth more and more money. So it's just a general slowdown in the economy. And then actually, as in the case of the Great Depression, it was a major slowdown. So you ended up obviously with even higher unemployment and issues. So we've been trained to like inflation a lot better than deflation. But in fact, if you've got some cash going into a deflation, your dollars become worth more. So it's not all bad versus an inflation where your dollars become worth less. And I don't think the average person really understands how serious a problem inflation is.
Yeah. We're talking to David Galland from Casey Research here on This Week in Money. Now you've scared the heck out of us. Tell us how we can protect ourselves against what is coming.
Well, here's the thing. There's not a whole lot you can do. I mean, there's two things. One is you definitely should own some gold. We recommend our customers, and we've been doing it for some time now, for years, recommend that they have about 30% of their portfolio in gold stocks, this sort of thing. If you don't have money in gold stocks, you may not get a better opportunity than what's going on right now. And by that I mean the bigger names, the producers, the guys that have got the gold in the ground. You've always got to be cautious about the little speculative juniors. And as far as those are concerned, you can make a lot of money in them, which of course offsets some of the downside. But what you've got to really pay attention to is companies' cash position, because you're going to have a situation where it's going to be hard for them to find money to move their projects forwards, which is the death knell for those companies. So, I personally would tend to like the larger gold producers at this point.
I guess it's like the old saying: when the tide goes out, we find out who's been swimming naked.
Yes, and in terms of contrarian opportunities at this point, if you look at how unloved gold stocks are, right at this moment. You're never going to find a better contrarian opportunity. I'm not just saying that. I'm not by temperament a gold bug or just a blind gold bug. But there's times like this when nobody wants to own stuff. That's when you want to buy it. But there is one thing I would mention that when you talk about protecting yourself, one of the problems, or a major problem, maybe even the biggest problem facing the U.S. and other economies, is that they've really been politicized. At this point, the governments are operating on no real principles other than to get reelected. They are willing to do literally anything. Therefore, there's no certainty. And you can't, when we talk about what can the government do to try to counteract some of the damage to the economy that they have done, people think in terms of quantitative easing. They think in terms of, suppressing the interest rates artificially, this sort of thing. But in reality, when push comes to shove, the governments of the U.S. and other countries at this point have no limits. They literally will do anything it takes. So if it's exchange controls in the U.S., we now have de facto exchange controls.
Okay.
I, as an American citizen, have a very hard time opening up a foreign bank account at this point because of the rules the government has put into place. They can do anything, confiscation. They can literally do anything. So it's very hard to protect yourself in that scenario other than diversifying yourself internationally if you can pull that off.
Yeah.
So that you're not stuck in one political jurisdiction.
David Galland is Managing Director of Casey Research. He is online at caseyresearch.com, home of the Casey Research Guide to Investing in Canadian Stocks. You check that out. As a bonus, you'll also receive Casey's Daily Dispatch. David, thanks for this.
My pleasure.
Coming up, Jeff Rubin on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Jeff Rubin's new book is The End of Growth. It's available in hardcover and Kindle from Random House. He's a former chief economist at CIBC World Markets, one of the first economists to predict soaring oil prices way back in 2000. Jeff's first book was Why Your World is About to Get a Whole Lot Smaller. He blogs for the Globe and Mail, and he lives in Toronto. Jeff, welcome to This Week in Money.
Good to be here.
Good to have you. Let's get the latest news on oil. $91 a barrel, regaining a little ground today after dropping to its lowest level since October. The usual suspects, the weaker dollar and the continuing drama in the Eurozone. Now, when you wrote the book, we were looking at triple-digit prices. We know the current price below $100 is just a blip. Are you taking any heat on that?
Well, first of all, just to set your listeners straight, oil still is over $100 because what you're quoting is West Texas Intermediate. Mm-hmm. Unfortunately, that's the price that Alberta tar sand producers are getting, and it's been about $15 to $20 off the world oil price, which is Brent. But even Brent is falling and probably will soon be in double-digit territory. What that's telling us, of course, is that the global economy is grinding to a halt. Oil prices fell all the way to $40 a barrel in the last recession. That didn't mean that oil had suddenly become cheap and abundant. It just meant we couldn't afford not to be in a recession.
Got some news here, Jeff, from the oildrum.com. 40 years worth of data they're looking at today shows a $10 increase in the price of oil means a reduction in growth of between 0.5% and 1% in the following year. They say it's basically an insurmountable speed limit on global economic expansion. Ties in nicely with what you're talking about in your book.
Right. I mean, what I'm saying is that when you go from a world of where oil used to cost $20 a barrel, which was only about 10, 11 years ago, to a world where we've seen $147 a barrel oil, even $100 a barrel oil, you just don't change the speed at which you drive your car. You change the speed limit in which your economy can grow. And unfortunately, that's something that governments and policymakers and economic institutions like central banks and finance ministries just haven't yet got their heads around.
You and I talked just a couple of seconds ago about an oil-induced recession. How do you see that unfolding?
Well, I think that we're looking at a recession unfolding right now in Southern Europe. We're looking probably at another financial market shock as big as the subprime mortgage shock that happened in 2008. And we're going to find that just as everybody around the world owned a little piece of the subprime mortgage market, we're going to find that everybody around the world's owning a little piece of Greece and Spain.
I love this comparison in your book, Jeff. You say the last recession is kind of like Sidney Crosby's concussion. Higher energy prices are not the symptom here; they're the cause of the problems we're having.
That's right, and I mean that's certainly not the way most people see it. Most people see it as a financial bubble bursting, but I think you got to ask yourself, what burst the bubble? And what burst the bubble was that inflation rates went from around 1% to 5.5% as oil prices went from $30 to almost $150. And even a reluctant Alan Greenspan, who was then the Fed chairman, was forced to raise interest rates 4 to 5-fold And, of course, that pricked the bubble. And when the bubble pricked, I mean, you didn't have to be in a realtor in the U.S. to feel it. In today's interconnected world of financial markets, banks from Toronto to Iceland started writing off billions.
In a recession, Jeff, what's going to happen? Are oil prices going to fall again, do you think?
Yes.
Okay.
And again, that's not going to make oil abundant. In fact, it'll make it even scarcer, because when oil prices fell to as low as $40 a barrel in the last recession, all of a sudden, tomorrow's world oil supply became uneconomic. For example, they cut $50 billion of capital expenditures in Fort McMurray because at $40 a barrel, the tar sands doesn't make a whole lot of economic sense. And not just the tar sands, the Brazilian subsalt, the shale oil in the Bakkens, deep water. None of these sources that we're expecting to supply us with oil in the future make sense at $40 a barrel.
We're talking to Jeff Rubin here on This Week in Money. We all know energy drives our economy. It's also driving the economies, emerging economies of Asia. How the heck are these people going to keep up with the energy demand there?
Well, you know what? Their economy is also going to have to slow down. That in a world of triple-digit oil prices, the Chinese or Indian economy can't grow at 10% anymore. And in fact, we've already seen Chinese economic growth ratchet down. It's now around 7-8%. I think when everything settles, we're going to see the Chinese economy grow at maybe 5% instead of 10%, because just like our own economy, triple-digit oil prices changes the speed at which economies like China, India, and Brazil can grow at as well.
Jeff, folks like Byron King have been talking about cheap oil and the end of cheap oil, peak oil, meaning the end of growth. And you're saying, yeah, okay, but is that really a bad thing? And the good news is it's not really. It could be a whole new paradigm here.
Well, I'll tell you one thing. I mean, if you're concerned about man-induced climate change and the impact of carbon emissions, this is a great news story, because this takes that out of the decision of Barack Obama or Stephen Harper or any politician. Once the economy stops growing, what happens is emissions fall, and we saw that as recently as 2009. U.S. emissions fell, even though the Waxman-Markey bill died on the Senate floor, and the Obama administration hasn't done anything to put a price on carbon emissions. Yet when GDP stopped growing in the U.S. economy, all of a sudden the U.S. economy emitted less emissions.
We're talking to Jeff Rubin on This Week in Money. One of the things you point out as being a net benefit from reduced oil is less consumption. Now, with 70% of our GDP depending on consumption, where do you see that heading?
Well, I think we're going to find that in this new world, less is more. We may not have to buy as many things in the past. If you look at countries that sort of rank the highest in human satisfaction, human well-being, human happiness, they're not the United States. They're countries like Denmark that doesn't have the biggest GDP or highest GDP per income. And I think we'll find that we'll be able to do with less without necessarily sacrificing our level of well-being.
Here's a great benefit, Jeff. More leisure time. I'm all for that.
Well, I think that's the way to go. In Germany, their Kurzarbeit program, their job-sharing program, saved about 1.5 million jobs in the economy during the recession. When the economy slows down, it's obviously not going to be able to create as many jobs as it did in the past. And I'm saying, instead of one person getting fired, why don't 4 people just give up 25% of their time? I mean, after all, you're not taxed on leisure. When you give up 25% of your income, Ottawa and the province is eating half of that.
I really like this approach also. It means less urban sprawl. That's especially important here in Vancouver and where you're from in Toronto. These cities are crazy.
And, in a world of triple-digit oil prices, commuting back and forth 30, 40 kilometers every day in your SUV is just not going to be economically possible. So again, I think we're going to see the migration of people from the far-flung suburbs back into the city. We're going to see an increase in urban density, and who knows, maybe even a return of those far-flung suburbs to the farmland that they were only 30 to 40 years ago.
Which is a great idea, because one of the things that we have to get used to is the idea of more local production, more local produce.
Absolutely, and that was really the punchline of my first book, While Your World's About to Get a Whole Lot Smaller, is that in a world of triple-digit oil prices, distance costs money, that it no longer makes sense to import everything from frozen chicken wings to steel from some faraway place like China just because their labor is cheaper, because what you will save in wage costs, you will more than squander in bunker fuel.
We're talking to Jeff Rubin here on This Week in Money. One of the things I had not considered to be a net effect here, and something you're probably one of the first people to point out, is this could be a better deal for women.
Well, I think certainly when you start talking about the challenges in the developing world, which are quite different than the challenges for British Columbia, when you start talking about Bangladesh, Pakistan, Uganda, and have a slowdown in economic growth, I mean, the immediate question is, how are we going to continue to feed exploding populations? I think there's going to be a lot more emphasis on population control, and the single most important determinant of bringing down birth rates is female literacy rates and the economic emancipation of women. I think even for brutal dictatorships, there's going to be an incentive to do that, because hungry people have three choices. They can migrate, rebel, or die, and I think much of what we've seen in the Middle East in the last year or so, the Arab Spring, really has its root cause in food prices.
Jeff, if there is any bad news in the book, it is that there's going to be fewer jobs for stockbrokers, mutual fund and insurance salespeople, and real estate agents. That's not bad.
That's true, and that's a sector that I spent a good part of my life working in. It's not that there isn't going to be investment banks and brokerage firms. There will, but instead of being 20% of GDP, I wouldn't be surprised if they're half that much. To make up their place, I think we're going to find a lot of those long-lost manufacturing jobs that we thought were gone forever are suddenly going to be coming home.
It's what you refer to, what a lot of folks call the fire economy.
That's right. And it's growing. It's basically doubled in size in countries like Canada and the United States from about 10 to 20%. A lot of that has to do with the financial market deregulation of the last 30 years. I think we're going to see the pendulum swing the other way.
Jeff Rubin's new book is The End of Growth. And Jeff, in the book you say central banks have a responsibility here to control inflation. But is not the money printing by central banks everywhere the cause of inflation?
Well, that's right. And if you're wondering why they're doing that, why we have zero interest rates or near zero interest rates, it's because they still think the economy can grow at the rate that it has in the past, and they're trying to feed it fuel. And I'm saying the only thing that they're going to fuel is inflation, not growth. And that we need to stop pretending that cheap money or huge budget deficits is a substitute for cheap oil, because unfortunately it isn't, and it's just going to make the adjustment to triple-digit oil prices that much more difficult.
Jeff, I want to get your definition of inflation. Our friend Mike Shedlock says it's an expansion of money supply and credit. Is that you feel about that same way?
Inflation is the rate of increase in prices, but prices are ultimately a monetary phenomena. So you start printing more money and more credit, and it's more money chasing a finite stock of goods. So prices go up. I think that again we're misled into believing that our economies can grow at the rates they have in the past, and we're taking measures that by all historical counts are not only unsustainable, but inadvisable.
Jeff Rubin is here with us on This Week in Money. Every week we talk on the show about stimulus, bailouts, quantitative easing, all the things that governments do to keep growth going. And these guys basically seem to be spitting into the wind here, don't they?
That's right. And, you look at the extraordinary measures that we have taken, both on the fiscal and monetary side, to resuscitate our economies. And then you begin to understand just how taxing, just how constraining triple-digit oil prices are to global economic growth.
Jeff Rubin's new book is The End of Growth. It's available in hardcover and Kindle from Random House. Jeff is talking to us today from Vancouver. And Jeff, best of luck on your book tour, and good luck with the book, my friend.
Oh, thanks very much. Great talking to you.
After the break, Sean Brodrick on This Week in Money.
American Manganese, Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
Sean Brodrick is editor of Red Hot Global Resources and Crisis Profit Hunter from Weiss Research. Check out Sean's always interesting blog at uncommonwisdomdaily.com. Sean, it's always good to have you on This Week in Money.
Oh, well, thanks very much for having me.
3-day weekend in the U.S. Markets closed Monday for Memorial Day, and let's look at some of the stuff you've been focusing on this week, starting with more indicators of a slowdown in China. This is serious stuff.
Yeah, well, it's one piece of bad news after another. They're using less electricity. Manufacturing's gone down. Real estate is just terrible across the boards. Apparently, there are big piles of metal that are now spilling out of the warehouses into the parking lots. It's one indicator after another. Now, the piece of good news is that the Chinese government seems to be aware of the problem and says that it is going to take steps to stimulate the economy, especially with infrastructure building and stuff like that. Of course, they didn't announce any specific plans. This was just from their cabinet earlier this week, Wednesday. So since they didn't announce any specific plans, the market kind of shrugged the news off. If they do get specific plans, that could be good news for the bulls. But right now, things look pretty bearish in China.
We're talking to Sean Brodrick on This Week in Money. With the Memorial Day weekend, AAA says 30 million people, Sean, will drive 50 miles or more away from home this week. That's about the same as last year. And summer gas prices averaging $3.80 a gallon. That's up slightly from last year.
Yeah, but the good news is that the price of gasoline has been going down by about a half cent a day over the past month to 6 weeks. I mean, it really was up more than that before, and as a result of the gas prices coming down, I mean, we can't say that it's a one-to-one correlation, but consumer confidence in the U.S. just it either hit a new 4-year high or else came close to a 4-year high. I can't really remember. But I think that a big part of that is the pullback in the price of gasoline. And so we'll have to see what happens. We now have the Seaway pipeline has reversed, which means that a lot of oil product, which was kind of hanging around in Oklahoma, is now going to be shipped overseas, probably to Europe and also Latin America, that kind of thing. But if the price of gasoline stays down, then consumers should remain confident, and so that is certainly good for the economy.
There's a good news story here, Sean. U.S. crude oil production is soaring.
Yes. I mean, it really is. Now, the most recent data we have is February, but the amount that was produced in February was the most for that month since 1989. I mean, it's just a huge gap. So what's been going on is all the shale oil, of course, and of course now we have all these companies, because they can't get a decent price for natural gas. Now they're shifting over to oil. That's bringing more oil on the market. And a lot of this is like exported. People say, well, how come the price of oil in the U.S. hasn't gone to like $40 a barrel? Because it can be refined and turned into product, which is then shipped overseas. And a lot of that is happening. That's good for America's economy and, good for exports and like things like that. There is some good positive news. However, there's also bad news for the U.S. That's the problem. I mean, regional manufacturing reports are mixed. Hiring is lackluster. And we have real roadblock in Congress, which prevents more economic stimulus. And now everybody's looking ahead to the, quote, fiscal cliff, unquote, which is the automatic cuts that go into effect in the U.S. budget at the end of the year if they don't come to some kind of agreement on the budget. And so we have our problems. And add to that, of course, is that no country is an island except for New Zealand. But we have these problems in China, in India, which is having a severe currency problem right now. In Europe, there's the ongoing problem in Europe, but it hasn't gone away. So because of that, I mean, our economy, we are seeing some good positive signs, but we have these other things around the world that are really weighing on us. And so a bunch of that has been priced in, and now we're seeing stocks try to bottom from here. But if there's more bad news from overseas, which is where I would think it would come, that can send stocks lower. And one thing I should mention is that the U.S. dollar, which was in a range for quite some time, has now broken out to the upside. Now, that breakout has to be confirmed. You can't just say, okay, it's up 1 week, that's great, let's all buy U.S. dollars. That move has to be confirmed. But if it's confirmed next week, then it's just an indicator that things are getting much more bullish in the U.S. dollar. That's because international investors are seeing what's going on in their countries, they're afraid, and so they're moving into cash, and they're moving into easily portable U.S. dollars. And so that is not a good sign. I mean, because if things are actually improving, you'd expect people to use those dollars to invest in things. Instead, they are selling other instruments and buying U.S. dollars. That's not a very good thing at all. So there are mixed currents in the market right now. We could be heading into another recession. I hope not.
Yeah.
But we have to take into account these things we are seeing, which are certainly warning signs, and so we have to pay close attention to them.
We're talking to Sean Brodrick from Uncommon Wisdom Daily here on This Week in Money. Speaking of mixed currents, one of the things you're writing about this week, natural gas, record levels of gas in storage, 2.75 trillion cubic feet, a record high for this time of year and way above the 5-year average.
Yeah, and that just shows, how productive this new technology we have is. And it's just turned out a tremendous amount of natural gas. Now, because we have so much gas, and really it's an enormous amount, we're seeing all these rigs switch over to oil. And so people would say, well, that means we'll have less natural gas in the future, and so the price of natural gas could go higher. Certainly it seems like it should. The price of natural gas could double, and it would still be below its 5-year range. So there is that potential. That said, there's still plenty of gas from all these wells that have been tapped coming into the market. And if the price does go up, there are plenty of wells that were tapped and then shut in because the price went down. Those can be retapped. So there could be pressure on the price of natural gas for quite some time. I'm not looking for anything really bullish in it, but if we can get prices, say, above $3.50, that's a price that some big players can actually live with, and so perhaps we'll stop seeing the carnage we're seeing in natural gas stocks if only we can get a little price rise.
More with Sean Brodrick next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're back with Sean Brodrick from Uncommon Wisdom Daily here on This Week in Money. We're talking about natural gas. Interesting piece that you're commenting on in your Twitter feed, Sean, from the Wall Street Journal. Will truckers ditch diesel for natural gas?
Yeah, and they speak about companies like Waste Management, which is in the Global Resource Hunter portfolio, by the way, which is actually switching over to around 80% of the new trucks it's going to purchase over the next 5 years will be fueled by natural gas. That's just one example. There are others making the switch as well because natural gas is so cheap. Even though, say, a waste truck that is powered by natural gas costs about $30,000 more than one that runs on diesel, each one saves about $27,000 a year in fuel. So that's easy math, and so that's why they're making the switch. And the problem is there aren't enough fueling stations, but of course we know T. Boone Pickens and people like that are actually working to put more fueling stations across North American highways. So if we see that go into effect, then it could be a sea change for like what's going on in the big trucking fleets. And if those start to run on natural gas, of course, that will lower the amount of oil that we have to import from countries that hate us. And of course, we also import it from countries that like us, like Canada, and we certainly appreciate your oil and stuff. But it really makes North America as a whole more energy independent and able to export more of our stuff to other places around the world. So this is good news, and it's actually something that I'm very happy to see.
Interesting factoid from the Wall Street Journal article: in the Asia Pacific region, natural gas vehicle sales have grown at an average annual rate of over 40% over the last decade.
Yeah, and natural gas isn't that cheap over there, though it should get cheaper once we start exporting it from the U.S. In 2015, 2016. Actually, we have one export terminal now up in Alaska, but I don't think that's even working. Where they get their natural gas exports is places like the Middle East, Qatar, stuff like that. And so I can see, though, that even if they're paying a higher price, there's a good reason for them to do it because the price of diesel isn't cheap either. In fact, India, which sells that kind of fuel at a subsidized price, just raised its prices, because it can't sell diesel at that price and and like actually keep operating. So they had to raise the price. So I think we'll see more of a change around the world, especially if they can get cheap natural gas from the Middle East, from the U.S., from Canada. And it's kind of a win-win situation all around.
You are with Sean Brodrick here on This Week in Money, and we're looking at Sean's Twitter feed, some of the things that you're focusing on this week. From Calculated Risk, they're asking, is QE3 just around the corner?
Well, the answer that if you read that article is they think that the market has anticipated that, which is why we've seen this bounce recently. And I think they're right. I don't think we'll see QE3 unless we see real deflation. Now, one thing that can help deflation is if the U.S. dollar rallies a lot, which looks like it could happen. We need confirmation, but it certainly has that setup. And if the U.S. dollar does rally, then we could actually see deflation. And if we see that in the context of an economic slowdown, then we could see more quantitative easing or something else. The Fed does have other, things in its quiver which it can pull out and use. It's just that that's the one we're all used to, but it could do something else along those lines. So I think it was premature. We haven't seen a move from the U.S. Central Bank or the European Central Bank, for that matter. But once we do, I would really expect the European Central Bank to loosen up. It just has to. And so if we see something like that, that could be a boost for markets. However, we could have a lot of pain before they finally do that. And that's one thing that makes this market so tricky right now, is that we aren't really investing on the fundamentals anymore.
Yeah.
If we were, there wouldn't be great miners that are selling close to book value right now. What we are investing on is when we think that the world central banks will do their next big intervention. And honestly, I don't have that answer right now, and so I've been kind of trimming down my portfolio. So I'm quite happy with how the gold miners in it are doing today. If we can have some more action like that next week, I'll be a very happy person.
We were talking off the air. We had a nice pop in the mining stocks this week. We had a nice jump in the both the GDX and the GDXJ. The GDXJ not so much, but the senior gold ETF did pretty well this week.
Yes. Well, because they're so damn cheap. I mean, when you look at where the prices of these big miners are, and then you get like Newmont, which has been leading gold recently, and it pays a 3% dividend yield. Its business isn't going to go away, and it looks like something that you might want to buy at this point if you think the price of gold is going to go higher. Now, let's switch to gold for a second to say gold is at support. It's bounced off that a little bit, but we really need to see it go up and break overhead resistance before anyone's really going to get too bullish on it, because there are some things that have gone wrong for gold recently. The good news, and I will give you that first, is that central banks are really stepping up to buy. We're seeing the Philippines and places like that buying a lot of gold recently. That's the good news. The bad news is the crisis that's going on in India. They are having a currency crisis. The value of the rupee is just sliding big time. Why is that important? Well, because if their currency is sliding, it's harder for them as individuals to buy gold because gold gets more expensive.
Okay.
And they are one of the major gold-buying nations in the world. Used to be number one, but now that belongs to China. So also, companies over there are having a real hard time getting credit now. So you put those things together, and, actually one of the real reasons that the Indian currency was sliding is they seem to be having economic stress as well. So there could be some problems in Indian gold demand. That and also consumer demand for gold is still lagging in the U.S. It's a good thing that the investors still seem to be stepping up to the plate, and the central banks are also pushing ahead and also buying a lot of gold. That's what has kept the price supported at these levels. But we really need to see, the rest of it come together for the price of gold to move higher. I was more optimistic on gold not too long ago, but we need to see it gain some momentum, or we could be looking at another leg down. So it's a very tricky time to be investing in gold right now. That doesn't mean that you shouldn't buy stocks that you have a really strong feeling will do very well down the road, because you can always add to positions and average in and stuff like that. But I don't think you should be in a rush to buy anything unless you're really, really sure that it's something you want to own, because you might end up owning it, again, at a cheaper price than it is now.
Sean Brodrick is editor of Red Hot Global Resources. Check out Sean's blog at uncommonwisdomdaily.com. And you can find Sean on Twitter at Sean Brodrick. Don't forget Sean's best-selling book, The Ultimate Suburban Survivalist, available in paperback now at your Amazon.com or Amazon.ca internet outlet. Sean, thanks for talking to us, and have a good weekend, bud.
Hey, you too. Thanks very much, Phil.
Thanks to our guests, David Galland, Jeff Rubin, and Sean Brodrick. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.